Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar. Welcome to the latest episode of State of Economy, where we are going to discuss about macro numbers, some of the high frequency economic indicators which have been made public during last 2 to 3 days. And one of the most prominent number is the GST collection number. And to talk about all those things, we have with us Mr. DK Srivastava. He is with EY. Mr. Srivastava, thank you very much for joining us.
Thank you, Shishir. Thank you.
So my first question to you about the GST collection, which is the second highest ever collection in the month of March with the 1.96 lakh crore. And during the middle of the last fiscal, there were a lot of concerns about the consumption slowdown. With this
Uh,
kind of number, do you see that the consumption has revived?
well, Shishir, as far as GST collection numbers are concerned, what is being released by Government of India are gross collections. 1.96 lakh crore in March 2025 can be compared with the data right at the beginning of the fiscal year. In April 24, it was 2.1 lakh crore. Between these two extremes of 2.1 and 1.96 lakh crores, there is a considerable seasonality that we can observe in the gross collections of GST.
Mm.
So what we find is that the gross collections actually peak in certain months, and noticeable peaks are observed after April. It is in July, and then October and November, and then after that it is January and March. So this is a seasonal pattern, which is actually also getting reflected in the March numbers. And around this time, actually, this seasonality is linked to some extent, to the agricultural seasonality, because Rabi and Kharif crops go through their harvesting season in these months. So that is one reason why we find that certain upsurges in consumption, expenditure, or sales actually become available. What may be a better indicator whether this is a lasting trend in terms of a fillip to consumption, we can look at the gross collections in terms of a monthly average. Now that monthly average for gross collections of central states is 1.84 lakh crore. That is a very robust number, is much better than last year or previous sets of years. And we notice that out of this, if we take out the refunds numbers, that is taxes paid on inputs and other refunds, then
Right,
what is left in the government kitty is about 1.61 lakh crore. So roughly about 21,000 crore average monthly refunds are there.
right,
So
sir.
what comes to the government kitty in terms of net indication of collections is about 1.6 lakh crore. That's a
Mhm.
robust number. If we look at the annual buoyancy of GST, it is higher than 1. Actually, this year it is close to 1.2. And therefore,
Right, sir.
I would say that subject to some adjustment for the seasonality pattern,
Right, sir.
consumption expenditure appears to be picking up on average,
Right,
and
sir.
it is being driven largely by rural demand.
Right, sir. Now, coming to the second high frequency economic indicator, which is the PMI manufacturing, and that was released on Thursday, I beg your pardon, on Wednesday, and it shows that it is at 8 months high in the month of March. How do you read that PMI manufacturing number, sir?
Well, in the month of March, this number is at 58.1. Anything higher than 50 is indicative of considerable demand being generated for manufactured products. So that is a very robust number. But if we look again at the monthly pattern over the year, that is FY25, then we find that in fact in the first quarter, PMI both for manufacturing and services, if you look at that, these are close to, for services it was close to 60, and for manufacturing it was close to 58.8, nearly 59. Then there is a downward trend for the second and further downward trend for the third quarter. Now there is a sign of, once again, this picking up. If we join this information or this signal that is coming out from PMI, that would indicate that in the fourth quarter, we expect a pickup in manufacturing growth and also services growth, because in both cases is touching 59 and 60 nearly. So it is also true that for the overall growth of 6.5% GDP, we require a significant pickup in the fourth quarter growth. In fact, if we look at the latest release of NSO data, then for 6.5% annual growth in FY25, we require a
Yes, sir.
7.6% growth in the fourth quarter. So
Okay.
the indication is that there is an upward movement after the dip in the third quarter at 6.2%. It may touch 7.6% or it may fall a little short of 7.6%. Either way, I think if 6.5 is not realized, at least 6.4, 6.3 to 6.4% growth in GDP would be realized on
Okay.
an annual basis.
Now coming to another number, which is a fiscal deficit number, and for the 11 month, we are seeing 86% of the revised estimate. And now, going by the trend in the capital expenditure, it seems that it may be lower even than the revised estimate. In that situation, do you see that the fiscal deficit coming down below the revised estimate for the current fiscal?
Well, it may come down, but only quite marginally as compared to the revised estimates. But remember that for capital expenditure, the revised estimates themselves were considerably lowered as compared to the original budget estimate. In the original budget estimate, the capital expenditure target was 11.11 lakh crore, and in the revised estimate, it was revised downwards to 10.18 lakh crore. Even that is not likely to be met. That lowered number is also not likely to be met. In fact, in the month of March, we would require a growth on a monthly basis of 44.5% for the Government of India to meet the 2025 revised estimate target of capital expenditure. So the expectation is that we may fall short of this. And if that is so, and also we look at the revenue expenditure numbers, there also for the full year revenue expenditure growth is expected to be 5.8%, but up to 11 months it is only 4%. So there may be some shortfall even in revenue expenditure. Both considered together, there may be some overachievement of the fiscal deficit target. However, it comes at the cost of sacrificing some growth. We looked at the growth possibilities in terms of the requirement of the fourth quarter at 7.6%. If it turns out closer to 7%, even though there is some improvement, we might actually land up at about 6.3 to 6.4. But I
Yes, sir.
am still hopeful that in the
Mhm.
month of March, there would be a peak in capital expenditure growth, which would also support investment demand from the side of government, and growth slippage may not be tangible. But one
Yes,
can
sir.
be sure that fiscal deficit target is going to be met, possibly even improved.
Okay, sir. Now, one concern, can we say this, like where we are seeing that the infrastructure development, which is measured in terms of the core sector growth, that's the eight key industries,
Right.
there we are seeing some slowdown. Is it a matter of concern?
This is a matter of concern, and this matter is linked to primarily the trends in capital expenditure growth of Government of India. In fact, both central and state government infrastructure spending has been underperforming in this current year. And it is because of that the core IIP sector is not showing a robust growth. So this matter is actually very largely linked to the government demand for infrastructure spending. Private infrastructure spending is still languishing, and therefore, unless there is further reduction in the interest rate, policy rate, I think that the driver for growth will have to be government of India and to some extent supported by the state governments. And therefore, this is a matter of concern. If our potential growth can be considered at about 6.5%, then to reach that level, government of India has to ensure that it is able to show at least a a buoyancy of expenditure growth or elasticity of expenditure growth reasonably higher than one. And in 25, there is a clear slippage in this, and the
Yes.
states are also not supplementing this effort. So
Mhm.
that if that happens, then our growth may see a slowdown as compared to our potential growth.
Sir, now the next high frequency economic indicator is retail inflation based on consumer price index, and that will be out on 14th of this month. What is your estimate about the number for the month of March?
Well, in the month of February, there was a happy trend in the sense that CPI number had fallen to 3.6% as compared to 4.3% in January. And I expect that this trend will continue. And if you look at the January February average, it is 3.9%. It is going to be definitely below 4% in the last quarter. If that is so, then the expectation is that this will prepare ground for the RBI seriously examine further reduction in the policy rate. And I expect that in the calendar year of 2025, possibly we may see an overall reduction of 75 basis points in the policy rate. If that happens, then there is a clear possibility of private expenditure also picking up, both consumption expenditure and investment expenditure. If that happens, then that is something that will fill up the slack in government demand. So I see the CPI inflation as a positive movement, which is preparing ground for interest rate reduction.
Okay, sir. Now, my final question to you, since we are in the first week of fiscal year 25-26, and there are a lot of expectations about this fiscal. What is your assessment about this fiscal? What kind of growth projections you have for this fiscal?
Well, in FY26, my expectation is that we should be able to come close to 6.5% growth, even though in FY25 there may be a marginal slippage. But in FY26, we should be able to see a growth of 6.5%. My expectation is based both on the strength of domestic demand, consumption, and investment, but also there is an expectation that global trends might take us towards a lower average level of energy prices, particularly crude oil and natural gas, because the policy push that is emanating from the US is very much directed towards ensuring that global energy prices come down. And they are increasing production of shale and so on, their own domestic. And they are also trying to persuade India to buy more from this and also persuade other potential suppliers, including Russia, put their supplies in a manner such that it becomes globally available. If that happens, then that will be highly beneficial for the Indian economy. So, although in terms of global trends, there is going to be considerable period of uncertainty in the next few months, but I think on average it will settle down in favor of India. If
Right,
so,
sir.
growth would be 6.5% or even higher than that.
Okay, sir. So thank you very much for talking to us and giving perspective to all the high frequency economic indicators. Thank you, sir.
Thank you, Shishir. Thank you. Thank you very much.